Wall Street is such a loud place, isn't it? It's all flashy headlines, crypto meltdowns, AI stocks going to the moon. But while we're all distracted by that noise, the smartest money in the room is quietly focused on a massive, hidden industry. And today, we're going to pull back the curtain on it.
So what is this secret obsession? No, it's not some hot new tech stock or the next big crypto coin. It's an industry that honestly sounds kind of boring by design. But it's been quietly rewriting the rules of the entire global economy, right under our noses.
And when I say it's big, I mean it is huge. We're talking about a $2.5 trillion industry. To put that in perspective, that is larger than the entire economy of Canada. This isn't some tiny niche market. This is a colossal force that has absolutely exploded, growing 10 times over since the 2008 financial crisis.
It's called private credit. And on the surface, it looks like the perfect investment, almost like an infinite money glitch. I mean, think about it. It's delivered returns that are right up there with the stock market, but with practically zero volatility. Now, if you've been around finance for a minute, you know that when something looks that perfect, there's always a catch. The real question is, what is it?
Okay, so to really understand this whole system, we've got to rewind the clock. Its origin story doesn't start in some boardroom with a brilliant new idea. Nope. It starts in the wreckage of the last great financial meltdown.
So picture this. Before 2008, if a medium-sized company needed a loan, it's pretty simple. You just go to a big bank. But after the crisis, a whole bunch of new regulations came down that made that kind of lending a massive headache for the traditional banks. So you know what they did? They just stopped. They basically ghosted an entire sector of the economy, leaving this huge lending vacuum.
And here's the number one rule of finance. Where there's a vacuum, someone will always rush in to fill it. Enter the shadow banks. Now, these aren't really banks in the way you and I think about them. They're giant private investment firms. You know the names: Blackstone, Apollo, Eris. They saw that void and just swooped right in, telling all those companies, hey, don't worry, we've got the cash you need.
So how exactly did this happen? Let's break down the mechanics of this whole boom and see why private credit became this absolute magnet for trillions of dollars from the world's biggest investors.
The concept itself is actually pretty simple. You can forget all the complicated jargon. It's basically just Venmo, but on a massive corporate scale. Instead of your friends sending you $20 for pizza, it's a giant private fund wiring $200 million to a company so it can expand, or maybe even avoid bankruptcy.
And here's the payoff. Over the last 2 decades, private credit has returned about 9.6% a year. The stock market? 10.2. I mean, they're practically identical. So if you're a giant investor like a pension fund, getting nearly the same returns with what seems like way less drama, that is a massive win. But that's only half the story.
This right here, this is the magic trick. You look at the stock market and it's an emotional roller coaster, right? It's up, it's down, it's all over the place. Private credit, on the other hand, it just looks like a smooth, steady, beautiful climb. It looks like you're getting all the reward of stocks with none of the risk. It looks safe. It looks stable.
But that perfect, smooth line is hiding a pretty uncomfortable truth. So it's time to look behind the curtain at what people are calling the volatility illusion. So we have to ask the critical question here. Why is that line so smooth? I mean, if these are loans to companies that were considered too risky for the big traditional banks, how can their performance possibly look so perfect? And here's the answer. That smoothness isn't from safety, it's from secrecy. See, unlike stocks, these loans aren't priced every second of every day in a public market. Instead, the fund managers themselves get to estimate the value based on their own private models. And hey, as long as the borrower keeps making their payments, it's really easy to just mark the value as steady.
It's been called Schrodinger's loan, which is just a perfect description. The loan is both perfectly healthy and on the verge of default at the exact same time. You just don't know its true state until you're forced to open the box, which, usually only happens when a borrower actually stops paying.
And this brings us to the true danger. Because in finance, risk never just disappears, it just hides somewhere else. And in the world of private credit, the real risk isn't the price going up and down, it's something else entirely.
The crucial risk here is liquidity, or to put it another way, it's the Hotel California of finance. The pension funds and endowments can check their money in, but when they need to get it back in a hurry, well, they might find they can never leave.
So here's how that could play out. Just imagine a recession hits.
The companies that took out all these private loans start to go under. The pension funds that invested billions need their cash back, so they try to sell the loans. But sell them to who? There is no public market for this stuff. If there are no buyers, their money is simply trapped, stuck.
And that's the big picture here. We haven't eliminated the risk that crippled the system back in 2008. We've just moved it. We've shifted it from the highly regulated, transparent banking sector into the opaque, less regulated world of private asset managers. It's all just happening in the shadows.
For over a decade now, with easy money, the music has just kept playing. The money keeps flowing, and everyone keeps getting paid. But in the entire history of finance, the music always, eventually, stops. So the question isn't if, it's when. And when it does, what are we going to find lurking inside this $2.5 trillion black box?